chances are that either you or somebody you know will be renewing their fixed rate mortgage over the next couple of years. And normally, this is not an exciting, inducing process. It's pretty pedestrian. You go to the bank, you sign the paperwork, and it doesn't add or subtract anything from your life. This time around, this might be very different. It might put a massive dent into your monthly outgoing expense budget, and it might even prevent you from home ownership. Is there anything we can do about this? Later in the video, I'll also cover what's happening with real estate prices across Canada with focus on Ontario, and we're also going to talk about the interest rate expectations moving forward. All right, so the first article is based on the Bank of Canada's report where they warned that mortgage payments due for renewables skyrocket over 60% by 2026. By 2026, Canadians who renew their mortgages that previously had variable rate mortgages with fixed payments will see the largest increase compared to the previous mortgage origination, expected to rise almost 62%. We as Canadians hold this belief that owning a house is a very important part of protecting your financial future. So you put your head down right after you graduate from university, you work hard for 25 to 30 years, and then you're ready to retire having paid off your mortgage. And then if everything in your life fails, your house will provide you with the financial stability necessary for you to retire in later years. And we're going through the period where this dream is being effectively shattered. Payments are expected to increase by 31.88% among all types of mortgages by 2026. Those who will be hit with the softest increase are Canadians who previously had fixed rate mortgages with a term of less than 5 years, who will see an increase of 19.26% by 2026. The time frame here is 2 years. We're always talking about what's going to happen by the end of 2026. Those who will be hit the hardest are homeowners who took out a mortgage between April 1st of 2020 and March 1st of 2022. So effectively when interest rates were at the extreme low and housing prices were going up unbound, things were increasing. Then we reached the peak in 2022 and things started changing. So at that time, the Canada's prime interest rate was at 2.45%. It is currently at 7.2%. So there's a massive jump in the prime interest rate. Canada debt to income ratio is the largest in the G7 despite household being second wealthiest. So this could be a bit of a confusing sentence, but what that means is that houses have appreciated so much for the majority of the population. Most of the Canadians have all of their money invested into their primary residence, which grew in value in the past 12 years. So that's where the wealth of the households is coming in. But people still have hard time dealing with daily expenses. So that's why the debt to income ratio is so high. Housing affordability reached an all-time low in April of this year, according to an RBC report. And the average household in Vancouver, and this is a refresher because I've covered this a lot in my previous videos, has to spend 106.3% of its income to cover home ownership costs. An average household income across Canada is around $100,000. So folks in Vancouver have to spend in excess of $100,000 to cope with the monthly household-related expenses. Sad. The share of Canadians with arrears and credit cards, so that's another testament that things are not all that smooth when it comes to the debt load of Canadian families. For those without a mortgage was at 2.22% in March of this year compared to only 1.05% for mortgage holders. Either mortgage holders are managing their money better, or they have access to home equity lines of credit that they use whenever they have to pay loans that bear a high level of interest. 1.31% of Canadians without a mortgage had arrears on credit cards for auto loans compared to only 0.2% of Canadian mortgage holders. Also disparity here. Households without a mortgage have increased their reliance on credit cards. As of March 2024, almost 46% of Canadians without a mortgage carry an outstanding credit card balance, and 23% of Canadians without a mortgage carry a credit card balance exceeding 80% of their borrowing limit. Wow. So 23% of Canadians will effectively not be able to qualify for a mortgage regardless of their income. If their debt load is in excess of 80% of the borrowing limit, that's it. They're out of options. They have to pay off their credit cards first, and then they can talk about getting their foot in the door and obtaining a mortgage and getting into a property. Next up is bubble contagion. This is the article on betterdwelling.com. Eastern Canada home prices retain the frothiest growth. And in this article, I want to bring your attention to a bar graph, which shows the percent change in composite benchmark price from March 2020 to peak in each province versus the change to March of 2024. The gray bar shows the percent change between 2020 and 22 when the market reached its peak, and then the black bar is representative of how things have changed between 22 and March of 24. So it's 2 years, 20 to 22, and 2 years, 22 to 24. Province of Ontario, prices have increased between 20 and 22 by 64.4% across the province, and then things have receded since 22 to 24 by approximately 30 points, 30% decline. So for a lot of people in the province, what that would mean is that upon renewal, if they realize that they can no longer afford monthly payments and they have to sell the house, the hope at least would be for them to be able to pull out more equity than they've put in. But if they bought at the peak, which is 21 or 22, and things have receded, not only will they no longer be able to afford monthly payments, but upon the sale of the house, they will not even be able to get the money that they've paid for the property in the first place. So that's pretty upsetting. If you look at the provinces further east, then things are not as dramatic. Even though the growth was roughly the same, but the drop-off after 2022 was very, very different. So for the PE, for example, we're dropping from 66% to 59%. Just a 7% drop. For New Brunswick, it's from 70% to 69%, barely noticeable. In other words, if people absolutely have to sell, at least there's going to be an increase in value, or they're going to be roughly in the same position as when they were purchasing in 21 and 22. And the last thing I want to cover in this video is the widely anticipated rate cut in June. There's been a lot of conversations that the Bank of Canada is planning to decrease the policy rate twice between now and the end of the year, with the first rate decrease coming in June of this year. And this was true even up until a couple of weeks ago. Before we get into the details on that, I just want to mention that a lot of folks hold a misconception that the policy rate from Bank of Canada will impact their fixed rate mortgages, but it will not. The best predictor where the fixed rate mortgage rates are going to go is the yield on the 5-year Government of Canada bonds. So that's where you have to look if you want to understand the dynamics of that particular segment of the market. Here we're talking about the impact of the policy rate on the variable rate mortgages and the economy at large. And normally these types of predictions are based on the 3-month futures traded on exchanges, so-called BAX future. So we can look at that and understand the probability of a rate change. So here this particular graph is showing us that the 25 basis point decrease is estimated to have a 42% probability right now. Let's look at the graph just below. What's been happening in April of this year? The implied probability of a decrease in the policy rate was at 61% then. Fast forward to today, and we're at 46%. So this chart is probably not reflecting the latest data, because right now it's showing the probability of 42%. So interest rates are not going down in June on the balance of probabilities. Things may still happen between June and the end of the year, but even that is far from being a guarantee. If the economic data is changing, rates can even go up. So that's something for all of us to keep in mind. And lastly, guys, I want to say this. On January 1st, after waking up after the new year and sobering up, one of the first thoughts that occurs to me is that, okay, I need to do taxes this year a bit earlier than I did them last year. And then I think, okay, I have about 3 months to go. I'll think about it tomorrow. Of course, I forget about the whole thing. 2 weeks before the due date, I remember, and I start scrambling, putting all the expenses together, sending them off to the accountant, having a series of feverish conversations with her about what else I might be forgetting to include in the package before sending it off to the government. Then, of course, once the package is sent, I'm realizing there are a few things that I forgot to include, and I'm shortchanging myself on the amount of money that I have to pay to the government. It is similar to mortgage renewals, except for between 24 and 26. If we're renewing, we're looking at a 60% increase to our household-related expenses after the renewal. So the pain curve is going to be a lot steeper if we don't leave ourselves the room to maneuver. And it's very important to have that 4 to 6 months of a buffer in order for us to actually act on the plan that we've decided on. So the first thing to do is you need to understand your numbers. You need to look at what the mortgage payments are going to be after the renewal. Once you look at that, you can decide what you want to do. So one of the options that you're going to have is maybe you want to consolidate your debt and roll your credit card debt with the interest of 21 to 25% per year into your new mortgage, where you'll be paying 6 to 7%, while at the same time remembering not to incur the credit card debt again. Another option that you might have is renting out a part of the house. So you can renovate the basement, install a kitchenette there, a washer and dryer, and you can supplement your monthly income, which will help you get through the tough times. If looking at the numbers and looking at the options, you decide that the only possibility for you is to sell the house, then you absolutely have to have that 4 to 6 month buffer for you to execute on that idea as well. And if you're not sure about how to go about the process of selling the property, reach out to us. You can either talk to myself, Vlad, or my partner Mitra. We're going to include the link to our calendar in the description below. The process is simple. You select the time that works for you, select the time that works for us, and we're going to have a 15-minute phone consultation with you. We're going to be talking about the specifics of your area, of your financial situation, most importantly, your objectives. Similarly, if you're a buyer and the buying journey is a mystery to you, reach out to us through the calendar link in the description below. That's about it. Hit the like button if you like the content. Consider subscribing to the channel. The easiest way to engage me in conversation is through the comments. I always respond to all of my comments, so please do that. Comment on the video, on the material that you see. Include the topics that you want me to cover maybe for next time. And if you're thinking that the economic conditions or the policy rate or the real estate prices are going to move in a direction that's beneficial for you in the short term, as in the next 3 to 6 months, you absolutely have to watch this video over here, where I have a sobering look at where we are as a nation with our debt load.